an analyst should consider whether the adjustments are appropriate or not by looking at these points. The first one is importance or materiality. Here the analyst should answer the question, is an adjustment to this item likely to affect the conclusion? If the answer is yes, then the adjustment should be made, otherwise not. The second point is the body of standards. The analyst should answer the question, is there a difference in the body of standards being used, that is US GAAP or IFRS? If yes, then in such a case, what are the areas of differences that are going to affect comparison? The third one is methods. The analyst should answer the question, is there a difference in accounting methods used by the companies being compared? If yes, then again the analyst should make an adjustment accordingly. And finally, the analyst should look into the differences that arises in the estimates used. If the important estimates exhibit differences that can affect comparison, the analyst should consider adjustments to be made. Accounting for investments in debt and equity securities of other companies other than investments accounted for under the equity method and investment in consolidated subsidiaries depends on management's intention whether to actively trade these securities, make them available for sale, or in the case of debt securities, hold them to maturity. When securities are classified as financial assets measured at fair value through profit or loss, similar to trading securities in US GAAP, unrealized gains and losses are reported on the income statement. When securities are classified as financial assets measured at fair value through other comprehensive income, similar to available for sale securities in US GAAP, unrealized gains and losses are not reported on the income statement and instead are recognized in equity. If two otherwise comparable companies have significant differences in the classification of investments, analyst adjustments may be useful to facilitate comparison. If one company is reporting inventory using FIFO and the other is reporting inventory using LIFO, it may affect comparability of financial results. Companies that use the LIFO method must also disclose the value of their inventories under the FIFO method. To recast inventory values for a company using LIFO reporting on a FIFO basis, the analyst adds the ending balance of the LIFO reserve to the ending value of inventory under the LIFO accounting. To adjust the cost of goods sold to a FIFO basis, the analyst subtracts the changes in the LIFO reserve from the reported cost of goods sold under the LIFO accounting. The International Accounting Standard Number 2 does not permit the use of the LIFO accounting method for inventory. Company A here is reporting under IFRS and it is using the FIFO method of inventory accounting. Company B is reporting under US GAAP and it is using the LIFO method. The slide gives data pertaining to current assets, LIFO reserves and current liabilities of these companies. Based on the data, compare the liquidity of the two companies as measured by the current ratio. To calculate the total current assets of Company B using the FIFO method, which is currently using the LIFO, we will have to add the LIFO reserves back to the current assets here, and that would make the total current assets of Company B under FIFO method equal to 100,000. We are not given the inventory amount separately, but it doesn't matter here. So to calculate the current ratio for both these companies, we go to the next slide, and here we see that the current assets of Company A under FIFO method including inventory are equal to $300,000 and the current liabilities are $150,000. That gives us a current ratio of 2 for Company A. For Company B, if we don't adjust for the FIFO, what happens is that its current assets are $80,000 and its current liabilities are $45,000. That gives us a current ratio of 1.78, which indicates that Company B has lower liquidity compared to Company A, but it is based on LIFO, so we have to convert the inventory of the Company B using the LIFO reserve to FIFO basis. So we add $20,000 in LIFO reserve to current assets, and that gives us total current assets equal to $100,000 now. If we divide this by the current liabilities, we get a current ratio of 2.22, which is higher than the current ratio of company A, and now both these are comparable because we have converted the LIFO inventory here of company B into FIFO basis, and that gives us a higher current ratio relative to company A. One of the conceptual difficulties with goodwill arises in comparative financial statement analysis, in particular comparing a company that has grown by making acquisitions with another company that has grown internally. The company that has grown by acquisition will have recorded the target company's underlying net assets and also goodwill on the basis of the total consideration paid for the acquisition. The company that has grown internally will have done so by incurring expenditures for advertising, staff training, and research, all of which are expensed as incurred under the US GAAP. Given the immediate expensing, the value of the internally generated assets is not capitalized onto the balance sheet. Based solely on the market value to book value, AMTD appears to be a better value company here. However, note that AMTD has significant amounts of goodwill and acquired intangible assets. What would the relative value be if the market to book value were computed after adjusting book value, first to remove goodwill and second to remove all intangible assets? Market to book value equals the total market value of the stock, that is the market capitalization, divided by total stockholders' equity. It is also referred to as the price to book value ratio because it can also be calculated as price per share divided by stockholders' equity per share. After adjusting for goodwill, SCHW appears to be selling for a lower price relative to book value than does AMTD, that is 4.8 times versus 10.7 times. AMTD has a negative tangible book value and therefore its price to tangible book value is not meaningful. Based on the assumption that the adjusted financial information provides comparability and based solely on this information, AMTD is relatively more expensive than SCHW. Another important adjustment that the analyst should consider is related to off-balance sheet financing. A number of business activities give rise to obligations that, although they are economic liabilities of a company, are not required to be reported on a company's balance sheet. Including such off-balance sheet obligation in a company's liability can affect ratios and conclusions based on such ratios. In this section, we describe adjustment to financial statements related to one type of off-balance sheet obligations, that is the operating lease. For operating leases, the analyst will be required to calculate the present value of future operating lease payments and add that to the total debt of the company and then use it in the calculations of different ratios. Similarly, the analyst will be required to make adjustments to depreciation expenses, interest expenses, as well as rent expenses. Effectively, the analyst will be treating the operating lease as a financial liability and an asset purchase at the same time. This will result in increasing interest expenses and increasing depreciation expenses simultaneously. However, it will also result in eliminating or excluding rent expenses. These will affect different ratios that are calculated, such as the interest coverage ratio and the total debt to total equity, as well as the total debt to total assets ratio